Introduction to free cash flows and business-friendly saving tools. Introduction. Every successful business needs a strong handle on its cash flow and savings. Knowing how much free cash you have and where to save it can determine your ability to grow, survive tough times, or take advantage of opportunities. In this video, we explore the meaning of free cash flow and look at practical saving tools that help businesses stay financially flexible and secure. Understanding free cash flow, FCF. Free cash flow is the money left after a business pays for its operations and invests in essential assets. It shows how much cash is truly available to use. The formula is free cash flow equals operating cash flow, capital expenditures. In practice, if a business earns $8 million from operations and spends $2 million on machinery, it has $6 million in free cash flow. That's money the business can use for growth, paying off debt, or saving for future needs. Why free cash flow matters. Free cash flow gives a business the flexibility to make decisions without relying on loans. Companies with healthy FCF can reinvest in operations, fund new projects, or reward shareholders. Investors often look at FCF more closely than profits because it reflects real liquidity. For instance, a Nairobi-based manufacturing firm with strong FCF can expand to Mombasa without seeking expensive credit. Calculating FCF, a simple example. Let's say your operating cash flow is $500,000. Your capital expenses, like purchasing trucks or factory upgrades, are $150,000. That means your FCF is $350,000. This figure shows how much is left to build your business, pay off debts, or save. A similar principle applies in a global setting. For example, a logistics company in Dubai might calculate FCF to determine whether to open a new regional office. Free cash flow versus net income. Net income is the profit after taxes and expenses. Free cash flow focuses on actual cash available for use after asset investments. Net income might look good on paper, but if your FCF is low, you may struggle with real expenses. FCF helps paint a clearer picture of what's truly available to operate and expand your business. Common challenges in managing FCF. Overinvesting in assets can reduce cash flexibility. Underestimating working capital needs can lead to cash shortages. Failing to plan for debt repayment can quickly erode free cash. A growing cafe in Kisumu may upgrade its kitchen too soon, only to find itself short on cash for staff wages and stock. How to improve free cash flow. Focus on growing sales through new products or markets. Reduce operating costs by eliminating inefficiencies. Delay or scale down capital expenditures that don't generate high returns. For example, an international software firm may lease office space rather than buy outright to conserve FCF. Introduction to business-friendly saving tools. Once your business has healthy free cash flow, the next step is protecting it. Business saving tools ensure you don't use all your money at once and stay prepared for future needs. These tools include business savings accounts, certificates of deposit, CDs, money market accounts, automated saving systems, business savings accounts. A business savings account is a low-risk way to store cash while earning some interest. It's ideal for keeping emergency reserves. Funds are accessible and protected, but interest rates are typically modest. A tailoring business in Nakuru might keep $300,000 here to handle slow seasons or urgent stock needs. Certificates of deposit, CDs. A CD offers a fixed interest rate for locking funds for a specific period, say, 6 or 12 months. It pays more interest than a savings account but penalizes early withdrawals. This is a good tool for saving money that's not needed immediately. A Nairobi-based law firm might invest $1 million from annual profits in a 12-month CD to build capital for a planned office expansion. Money market accounts. These accounts blend the features of savings and checking accounts. They offer higher interest and allow a few limited transactions. They're suitable for short-term goals that still require some liquidity. In the US, many mid-sized firms use money market accounts to hold funds set aside for tax payments or contract obligations. Automated saving systems. With automated saving tools, businesses can schedule recurring transfers to savings or investment accounts. This builds consistency in saving without needing constant manual effort. It's an easy way to align with business goals. A digital marketing agency in Nairobi might set up an automatic KES 20,000 monthly transfer to a savings account dedicated to upgrading equipment every 2 years. How to choose the right saving tool. Ask yourself, how soon might I need this money? Am I okay with locking it up for a year? How much return do I want versus how much risk can I handle? For example, a supermarket in Kisii might need liquidity for fast stock turnover, so a savings account fits better than a CD. Combining free cash flow and saving tools. Start by reinvesting part of your free cash into areas that fuel growth. Put another portion into savings or money market accounts for emergencies or tax payments. Maintain enough liquidity to meet payroll, buy supplies, or handle sudden expenses. This balanced approach protects your operations while allowing smart growth. Mistakes to avoid. Not saving enough leaves you exposed to cash crunches. Oversaving in low-interest accounts reduces your returns and growth. Not forecasting your cash needs leads to unplanned borrowing. A graphic design studio in Eldoret, for instance, might save too aggressively and then struggle to pay staff during a low-revenue month. A realistic business scenario. A company earns KES 50 million annually in free cash flow. It uses KES 20 million to expand operations in Nairobi. It saves KES 15 million in a business money market account. It puts KES 10 million in a 2-year CD for future acquisition plans. It sets aside KES 5 million in an automated emergency savings system. This structure allows both security and growth, with a clear strategy for every shilling. Summary of key points. Free cash flow is the foundation for business flexibility. Savings tools like CDs, savings accounts, and automated systems help protect and grow your funds. The key is balance. Don't tie up all your cash or leave it idle. Match your cash allocation with your goals, risks, and operational needs. Closing message: secure and grow your business. Every shilling your business earns should serve a purpose, whether to grow, protect, or save for tomorrow. When you manage your free cash flow wisely and use the right saving tools, you build a business that's not just profitable, but resilient. Whether you're running a fast-growing Kenyan startup or managing a stable multinational company, financial discipline is your best strategy. Take control of your cash, invest wisely, and keep your future secure. Thanks for watching. Stay smart, stay steady, and keep growing.